Hi everyone, welcome back to another session on strategic financial management. So today we're going to do the topic on financial ratios, and I'm going to give you a brief introduction on financial ratios. So I'm aware that most of them know the topic or know what financial ratios are, and also I believe that I gave a brief explanation on where and how this is used in financial management. So let's learn about financial ratios, what financial ratios are about. So businesses, they use financial ratio to compare the performance of the businesses with the past years. Now you may ask a question, why do we need to use financial ratios? Obviously, just by looking into the financial statements of the organization, you'll be able to figure out which year the organization has done better. Because when you look into the profit and loss of the organization. Yeah, you have numbers 2024, 2025, 2023. So you have the performance level and they're in numbers. So obviously, when you compare, say 2025, they performed well, they had a higher profit compared to the other years. So you will come to a conclusion fine. 2025, they performed well compared to 2024 and 2023 simply by comparing their profits. Now, does it really give the true picture of the organizational performance? No. That is the reason we do or we calculate the financial ratios to find the performance of the businesses. Not just past years, but also you can compare your organization with another organization using financial ratios. So that is what we are going to learn today. So financial ratios, as I told, businesses use financial ratios to compare the performance of the businesses with the past years. This is one reason as to why we use financial ratios. And this is an effective way of measuring the performance of the businesses, and it is easy to calculate and quick. Yes, trust me, financial ratio is very easy. You have the formulas, you just have to learn what the formulas are, and then you take numbers, you take information from the annual reports and simply substitute in the formulas and then calculate. And again, calculate, you don't do manual calculation. You can use a calculator or you can use Excel sheet to do the calculation. That's it. So calculation part is not hard. The harder part is the analysis and the interpretation. So if the answer is X, so what? If the answer is A, so what? So this is the harder part. So for you to do the analysis or the interpretation of the financial ratios, you should be really thorough on the financial ratio area. So number two, an effective way of measuring the performance of the business, and it is easy to calculate and it is quick. Yes, it is quick as well because it's easy. Now, when it comes to data collection, you just need access to the annual reports, right? So if you have the access to the annual reports of any organization, you're able to calculate the financial ratios. It's easy as that. So getting the access to the secondary reports of an organization is easy because all the organizations that are registered with the stock exchange, they have to publish the annual reports every year. So you definitely have access to the annual reports. And also this shows the financial strength and weaknesses of the business. As I told you, just by having a glance or just going through the financial statement of the organization, you really don't know what is going on in the business. You can't decide that this business A is performing better than business B just by looking into the profits of the organization. This cannot be done. Right? This cannot be done. You have other factors that you need to consider when comparing the financial performance of the organization. Clear? So, as I said, although the ratios are easy to calculate, what's difficult is to interpret and make financial decisions pertaining to those figures. So financial ratios are tools that is used to assess the relative strengths of companies by performing simple calculations on items such as the income statement. You also use the statement of financial position. You take some of the information from statement of financial position. And on rare occurrences or rare situations, you also take information from the equity and also the cash flow statement of the organization. So ratio, they measure companies' operational efficiency, liquidity, stability, and profitability, and also they give information to the investors, to the potential investors, more relevant information than raw financial information. Right? So by using the financial ratio, the results of the financial ratios, the investors can decide whether to invest in this company or not. Whether to invest in this company or not. Right? So these are the reasons why financial ratios are used by the organizations. Now let's look into the importance of financial ratios. Number one, it is a standardized method of comparison. What do you mean by a standardized method? Now, financial ratios, they provide a standardized method with which to compare companies and industries. Using ratios puts all the companies on a relatively equal playing field in the eyes of the analysts because they are all in one particular game, right? So whether it is company A, company B, company C, company D, any company, whether it is manufacturing, whether it's a service, whether it's a, let's say, a middle company, any type of company, you use standardized financial ratios. So you're not going to use a different set of formulas for A, different set of formulas for B, different set of formulas to C. No. All four companies, we are going to use the same financial ratio formulas to calculate the performance. So that's the reason it says a standardized method of comparison. And also, when it comes to financial ratios, you can simply calculate the financial ratios for any company, any size, any industry. Right? Any industry. Maybe A has more market share than company B, it doesn't matter. We can calculate the financial ratio and we can compare. Because this really doesn't matter. Market share, the size of the company, the investment of the company, the profit of the company, it doesn't really matter when it comes to the financial ratios. You're able to compare company A, meaning you're able to compare a multinational company with a small business, small and medium business company using financial ratio. So that's the reason it is said a standardized method of comparison. Right? As I told you, comparing the raw financial information of two companies in the same industry will only give you a limited insight. In fact, it's very difficult for you to compare a multinational company's profit with a small and medium company. Obviously, because multinational company will boast their profit. They will have a higher profit compared to the small and medium company. And when you look into it, you'll be like, okay, the multinational company has performed well because they have a higher profit than the small and medium company. But when in reality, small and medium company has the potential to improve more than the multinational company. So how do we understand this? By calculating the financial ratios. Get it? So an older company, for an example, they might say that they have 50 times the revenue of a small business company. Now, the older company, at a glance, it might seem that the older company is stronger than the small company. But when you analyze the two companies with the ratios, example, ROE, which is ROE means return on equity investment, return on equity formula, or the ROA, return on asset, you will be able to find out that actually the smaller company's operational level is much better than the multinational company. This is the reason why financial ratios can be used. Number two, it is used for industry analysis and benchmarks. What does this mean? Now, ratios, they can reveal trends in particular industries, creating benchmarks against which the performance of all industry players, and this can be measured. Say you have 5 industry players, right, for a specific industry. Say for an example, let's say, let's say mobile phone. Just an example, hypothetically, just imagine that in the mobile phone industry, there's only 5 companies who is playing in the market, A, B, C, D, and E. And out of these 5 companies, imagine that A is performing well. They're outperforming the other companies in terms of every aspect, right? They're amazing. So A will set a benchmark, right? So B, C, D, E, they will be able to, or they will consider A as their benchmark, and they'll try their best to reach their position. And this can be analyzed using financial ratios. And also small businesses, they also can use industry benchmarks to craft organizational strategy and clearly measure their own performance against the industry as a whole. So this is another importance of financial ratios. Number 3, stock valuation for strength and weaknesses. Now, the common language and understanding of ratios helps investors and also analysts to evaluate and communicate the strength and weaknesses of individual companies or industries. Fundamentally, analysis is a term given to the use of financial ratios in determining the relevant strength of companies for investing purposes. So when the investors decide, or when they are seeking to invest in companies, they will definitely evaluate the strength and weakness of a company. You can't blindly invest in a company. Yeah, you should find out which company has the potential to make more profit, which company has the potential to give you a better return on your investment, which is known as ROI. So all these can be analyzed via financial ratios. Clear? So a careful analysis of a company's ratios can reveal which companies have the fundamental strength to increase their stock value over time and have the potential to be profitable in the future. Now, all these can be analyzed via financial ratios. And number 4, planning and performance. So ratios, they can provide guidance to entrepreneurs when creating business plans or preparing presentations for lenders and investors. So usually the companies will be preparing presentations. They will try their best to impress the investors. They'll say, you have to invest in our company because we will be giving you these benefits. Yeah. So via financial ratios, via numbers, you're able to say the investors, this is what we're able to give you as a return. This is the percentage, say 20%, we're able to give you as a return. So this is definitely going to impress the investor. So investor, mind you, investor is not just going to come to your company only. They will go to company A, company B, company C, company D, company E, and then compare all these companies and then decide which company to invest based on the benefits they get from the company. So it's really important for you to show what potential you have, right? What strength you have to these investors. At the end of the day, you need the money to run your business. Yeah, and one of the best ways to get money is via investors. One of the best way, rather. So these are the 4 importances of financial ratios. Of course, there are more, but I just only highlighted the most important importances of financial ratios. And now let's move on to the different types of financial ratios. So financial ratios are basically divided into 5 categories: liquidity ratios, efficiency ratios, profitability ratios, debt management ratios, and investors ratios. Right. So now let's look into liquidity ratios. What are liquidity ratios? Under liquidity ratios, you have many ratios. Quick asset ratio, also called as asset test. You have current asset ratio. You have many ratios under liquidity ratios, which you'll be learning in the future. For now, remember, there are 5 categories under ratios, which are liquidity, efficiency, profitability, debt management, and investors. First, let's look into liquidity ratios. What does liquidity ratios do? These ratios help the business to evaluate the liquidity position of the business, whether sufficient resources are available to meet the liabilities. Now, they will help the business to evaluate the liquidity position. How fast can the company sort of convert their resources into cash? This is liquidity ratios. Why do we need it? Now, this determines the ability to cover short-term obligations. So, as I said, liquidity is the ability to convert the resources into cash quickly. Right? You may ask me, why do we need to do that? Because we need money, we need cash to run the daily operational activities. If you run out of cash, what happens? You're unable to meet the obligations. Now, when you don't have enough cash in the business, and when you're unable to convert your resources into cash immediately, you have certain obligations to meet. What do? Then we try to find other sources of finance. Right? So usually what? Loans. Now this will affect the debt management ratio. So that's the reason it's very important for you to have a good liquidity ratio. So importance of liquidity ratios is determine the ability to cover short-term obligation, and also they determine the credit worthiness, and also they determine the investment worthiness. Now, what does this mean? Okay, first let's look into the first important, which is determine the ability to cover short-term obligations. Now, liquidity ratios are important to investors and creditors to determine if a company can cover their short-term obligations and to what degree. And to what degree. For an example, you will be learning everything in detail. I will explain it to you what one means, what one is two means. I'll explain everything in detail. For now, remember, a ratio of 1 is better than the ratio of less than 1. Right? So this is the comparison. So if company A is 1, whereas company B is 0.5, you can say that company A has a better liquidity ratio compared to that of company B because they are able to convert their resources, their assets into cash quickly. Right? And when it comes to creditors and investors, they expect this ratio even to be more high, maybe 2 or 3. So the higher the ratio, the better it is for the company. Number 2, determine credit worthiness. Now, creditors analyze liquidity ratios when deciding whether or not they should extend credit to a company. So they want to ensure that the company they lend has the ability to pay them back. So if the liquidity ratio is low, then the creditors are not going to lend you the money. That is why determining credit worthiness. So it's very important for you to have at least an average liquidity ratio. Number 3, determine investment worthiness. Now, for investors, these people, they will analyze a company using liquidity ratios to ensure that a company is financially healthy and worthy of their investment. And now here comes something called working capital, which you'll be learning. Probably under sources of finance, in that area, you'll be learning something called working capital. So it's very important for the working capital to be healthy. Right? So low liquidity ratio is a red flag for the business. Higher, the better. Remember that. So this is about liquidity ratio in a nutshell. Next, we're moving on to efficiency ratio. Remember, all these ratios, liquidity, efficiency, profitability, debt management, these are just types of ratios. Under these topics, you have different ratios that you'll be learning probably in the next session. Okay, so this is just an introduction for you. I'm just introducing you to the ratios, what it means, why do we calculate it, why is it important to calculate it. So that is what we're learning here. Right. In efficiency ratio, this measures which resources have been used effectively in the business. Now, efficiency ratios, they are the metrics that are used in analyzing a company's ability to effectively employ its resources like capital or assets to generate income. Right? So these ratios serve as a comparison of expenses made to revenues generated, essentially reflecting what kind of return in revenue or profit a company can make from the amount it spends to operate its business. This is efficiency ratios. How efficiently a business is using the available resources. Importance: analyzes a company utilizing its assets and liabilities with efficiency, measures the efficiency or effectiveness with which a firm manages its resources and assets. So it's very easy to understand as to why we use efficiency ratios. I hope so far it's clear. Am I too fast? Is my speed okay? Zahra, is it okay? Or am I too fast?
No, ma'am. Okay.
It's fine. Okay. Thank you. Next, profitable. I personally love ratios. This is one of my favorite area in finance. I do this a lot. I think, my master's research was basically, not basically, I actually used ratio as my, how do I say? It's like I used it for measuring something. So I calculated probably 1,000 to 2,000 calculations on ratio. So this is one of my personal favorite when it comes to ratios. So for my master's thesis, I used something called the Camel's model, right? So I was comparing the financial performances of conventional and Islamic banks using the Camel's model. Right? So this Camel's model is a very famous model that is being used to analyze the bank performances, and this sort of compares the overall aspects of a bank. So under Camel's model, now C stands for capital adequacy, A stands for asset quality, M management, and so on, and L's liquidity, efficiency, sensitivity to market. So under capital adequacy, you have ratios. Get it? Under assets, you have ratios. Under management, you have ratios. Under this, you have ratios. So you have 3, 4 ratios under each category. And I have to analyze each of these ratios for 20 banks for 5 years. So 5 years, each bank. And I have to do these calculations for each year. Now you can understand how many calculations I've done. I don't actually have the copy of my thesis right now, but I'll show you in the next class, like how much of work I had to put in to calculate the ratios, but it was quite interesting. I loved doing that. I loved doing it. So I collected annual reports from the websites of the banks and then did my analysis for the thesis. It was an amazing research that I did. So it was just one aspect. I used the Camel's model just for one of my analysis for financial performance. So basically, this was my primary measurement that I used for my research. So that's why it's my personal favorite, and it's amazing, guys. It's amazing. This is something that you're going to be really invested when you're doing your assignment. Right. Finally, moving on to profitability ratios. Now, easy. Profitability, just as the name suggests, profit. This measures the financial wealth of the business. Right? So, profitability ratio, this assesses a company's ability to earn profits from its sales or operations or shareholders' equity. So, profitability ratios include how efficiently a company generates profit and value for shareholders. Higher the ratio, favorable. The higher the ratio, the better it is for the company, just like the liquidity ratio. Right? So assess the efficiency of cost management, demonstrates the overall performance of a company. Yes, at the end of the day, all that matters is what? Profit. That's the main reason why you start a business. Yeah, that's the main reason why you start a business. Helps the management in managing the utilization of assets. So these are some of the importances of profitability ratios. Again, I repeat, you have many ratios under these ratios. These are just categories that I'm explaining today. Next, moving on to debt management ratio. Yes, one of the most important ratios under ratio analysis, debt management ratios. This measures the relationship between the owner's wealth and the cash contributed by the other parties in the form of a loan. What is it? It's the relationship between the owner's wealth and the cash contributed by the other parties. This is debt management ratios, right? This is debt management ratio. Now, debt management ratio measures the firm's ability to repay long-term debt. It is a financial ratio that indicates the percentage of a company's assets that are provided via debt, right? So debt management ratios are particularly important for the financial analysis of a company, right? Why? Because we are trying to find out whether this company is able to repay the long-term loans. Importance: enable potential investors to examine the health of a company. So if the company is running on loans, although the profit is high, although there are certain companies, they are basically running on loans, but their profit is high. So what is going to happen in a couple of years? Will the company survive? Will the company be able to settle the loans? At that particular year, yes, the profit is high. But what's going to happen in another 5 years, 6 years, 7 years? You can't say just by looking at a profit and loss account or income statement. That's the main reason why you calculate the debt management ratio. This will tell you whether this company is better than the other company in terms of debt management. Clear? Help in understanding shareholders' earning signifies the entity's trustworthiness and how regular they are in regards to payment of installments. So this is debt management ratio. And finally, we are moving on to investors' ratios. Now, these ratios provide the necessary information to the investor of the company. It calculates the returns and the performance of the business. Being able to compare investors' ratios can mean the difference between investing in a good company or a bad company. Obviously, when it comes to investments POV, point of view, right, in investors' point of view, the investor will invest in a company that gives him the higher return. Yeah, at the end of the day, he needs a high return. But at the same time, investors also will look into the potential survival, whether this company is able to survive, whether their investment is safe in this company. So additionally, this investors ratios will be one of the main or primary focus, but additionally, they'll also look into the other ratios, especially profitability and debt management ratios. Right? So these are the investors ratios. So we went through 5 types of ratios, which is we went through liquidity ratio, efficiency ratio, profitability ratios, debt management ratios, and finally investors ratios. And now let's look into the limitations of financial ratios. Yes, number 1, historical information. Now, what are annual reports? What are annual reports? These are the past performance of the company, not the future performance. This is something that has already happened. So when you're calculating the financial ratio, you're using the historical information. So sometimes it's difficult for you to predict the future just based on the historical information, because there's so many unexpected events that may happen. For an example, the pandemic. Yeah, the pandemic. It shut down the whole world. Banks collapsed. Not collapsed, but they suffered. Companies collapsed. Yeah, so most of the companies, they had to shut down because they could not survive. Yeah. So this is one of the limitations of financial ratios. Next, inflationary effects are ignored. Yes. Now, financial statements are released periodically. Sorry. And therefore, there are time differences between each release. So if inflation has occurred between these periods, then real prices are not reflected in the financial statement. Thus, the numbers across these different periods are not comparable because inflation effects are ignored. And that's the reason in camels, we use something called the S sensitivity to market, right? Next, changes in accounting policies. If the company has changed the accounting policies and procedures, again, this may also significantly affect financial reporting. It's like some companies, yeah, that is the next thing, which is manipulation of financial statements. So in accounting terms, you call this window dressing. In accounting, you call the jargon, accounting jargon, you call it window dressing, meanings manipulation of financial statements. Yes, you can manipulate financial data, right? You can prepare your annual reports, you can prepare your financial statements, right? You can prepare the financial statement in a way when you calculate the financial ratios, all these ratios will be favorable to the company. So you can manipulate financial statements. So this is another limitation, right? This is another limitation in financial ratios. So today we covered the topics on financial ratios. I gave you a brief introduction of what financial ratios are. And then we went through the importances of financial ratios. We discussed the 5 main types of financial ratios. And we learned the limitations of financial ratios. So thank you so much for attending the session today. I'll see you next week with another session.